Hello everyone. So today I'll be presenting an important analysis on forecasting diesel sales prices in the United States. So diesel is the lifeblood of industries such as transportation, logistics, farming and manufacturing. Accurate diesel prices forecasting help businesses plan better and maintain operational stability. So the analysis I'm sharing involves data collection, historical analysis, model building uses RMI and ETS, and forecasting future trends to understand prices behavior and their risks. Diesel plays a major portion of the US economy, and even a slight fluctuation can lead to the cascading effects and operational costs within the organization. With the economic activities heavily depends on transportation and logistics, diesel price predictability become very crucial. So my motivation here was to study these patterns to enable better decision making for business and for the policymakers. Through data modeling, I aim to predict the future trajectory of diesel prices and provide actionable insights. Diesel prices are highly sensitive to external events such as supply chain disruptions during COVID 19, geopolitical tensions, and the government policies. So, Canada and Mexico will consider as the main exporters of diesels to the United States. So, previously it used to be a 0% tariff on those countries. So, if you consider the renewal government policies for those countries, there is a 10% tariff on Canada, and there is a 25% tariff on the Mexico, so which makes the diesel prices uncertainty. So the industries are keep on struggling to set budgets accurately and facing challenges in contract and pricing when diesel prices are volatile. Diesel prices in the US are highly volatile, influenced by global oil markets, supply chain issues, and seasonal demand. So, this unpredictability creates challenges for industries which mainly relies on the diesel and for the operational and logistics. So, to support better planning and cost management for the organization. So, here I'm aiming to develop a forecasting model that accurately predicts US diesel prices by analyzing the historical data trends and key economic factors. So, to discuss the overview of the data set, there are two key variables that I have been using for the forecasting of the diesel sales prices. The first one is the observation date, and the other one is gas desk. So, the gas desk stores the diesel prices per gallon, and the time span that I have considered is from January 1994 to early 2025. Mm, it's like over 30 years of weekly data. So this data gives us a robust long-term view to identify both gradual trends and the sudden disruptions. Here, the analysis of this plot discuss about the monthly diesel prices over time. So, if you observe the trends of this plot, there is a gradual long-term increase in the diesel prices over the decades. And if we see the spikes, so there is a big jump during the crisis periods, like the pandemics and 2008 financial crisis. So the overall pattern sensitivity discuss about the diesel market reacts sharply to the global events, and it also highlights the need for model that can adapt to the shocks as well as the trends. And if we see the trends around 2120, so the diesel prices decreases but are still higher with the historic law. This plot is going to discuss about the full historical diesel prices, where we can see the clear upward trend with the dramatic price swings. Uh, a repeated rise and fall pattern suggests that the diesel prices are tied closely to both the global and domestic macroeconomic trends. So this graph shows historical diesel prices from 2020 onwards, which highlights major market shocks and provides the foundation for our predictive modeling. So here I use the auto-regressive integrated moving average model, which is perfect for time series forecasting with patterns, trends, and randomness. So if we talk about the forecasting interpretations of this plot, so the blue line indicates that there is a stable trend for diesel prices, but there might be a chance of increasing in the future. So if you see the little shaded gray area in the plot, so it discusses about the confidence interval, showing the range of possible outcomes. And if you see the key message of this plot, so the diesel prices expected to be increased over the period. So the forecasting using ARIMA suggests a increase of the diesel prices, but with the growing Earth's uncertainty over time, as shown by the expanding confidence interval. So the other model that I use for forecasting is ETS, which stands for Error Trend Seasonal. So the ETS models are good for capturing patterns with exponential smoothing. So if you see the interpretations of this plot, the forecast shows a mostly horizontal trend, which suggests near future diesel prices will stay steady. However, the widening cones meet greater uncertainty the further we forecast ahead. So, stability is expected short term, but uncertainty remains a factor long term. So, the model forecasts diesel prices to stabilize in the near future, but signal high uncertainty beyond that, reflecting the limitations of the time series based on the predictions like ARIMA. So here we are going to discuss about the RM or residuals. So basically residuals are the difference between the predicted and the actual values. So that's going to help us uh, to assess the model quality. So here if you observe the observations, so the random patterns are around zero. So there is no major bias left in the model. So if you see the second lag, so there is no auto correlation, which indicates the past errors does not predict the future errors. So here if you see the third one, there is a bell curve which states that the residuals are roughly normal. So the RMA model is fitting the data well, and errors behave like pure noise. So the residual diagnostics shows no major patterns or autocorrelations, as the residual is roughly normal, supporting that the RMA model is a reasonably good fit. So here if we see the ETS residuals, which is similar to the aroma residuals, it is around zero, so it states as no bias and no strong autocorrelation. So there is a slightly more centered distribution compared to arema, but minor imperfections. So ETS is a good model too, but a little less perfect than arema in handling the diesel price volatility. Both arema and ETS model fit well, but here choice depends on the forecast accuracy matrices like RMSE and the maze. So here let's observe the maze score for the both models. So maze stands for mean absolute scale error. It's a performance matrix used to measure the accuracy of your model. So in a simple terms, it tells how good your model predictions are compared to the basic reference models. So the lower the maze is, the better the accuracy of the model is. So here if you see, the aroma model achieved a maze score of 0.82, which indicates that it's a best fit with the smaller forecast errors. It accurately captured the both long-term trends and the short-term volatility. Also, the residuals behave randomly, meaning no patterns were left unexpected. So if we see the ETS model maze score, it is somewhere around 0.97, which is also a smoother but slightly less accurate compared to the arema. So it managed damping trends well, but still showed some minor inequalities. So residual here also behave randomly, which is a good sign. The main takeaways of this forecasting analysis are, so the RMA model is the most accurate and reliable forecasting tool. So as we already predicted the future prices, so diesel prices are likely to remain stable with the moderate risk. So stable prices mean business can better budget transportation, logistics, and farming operations. However, industries must stay cautious and monitor external factors that could trigger new volatility. Forecasting diesel prices helps industries mitigate risk, and robust models like ARIMA can offer crucial predictive insights in these uncertain markets.